If you are currently paying for a Medicare Supplement policy, also known as Medigap, I need you to stay with me until the very end of this video. Because what I'm about to share could save you hundreds, and in some cases, thousands of dollars on your healthcare premiums this year. And I mean real money. Not the kind of savings where you clip coupons and feel good about 50 cents off a can of soup. I'm talking about 3 specific Medicare supplement traps that are secretly overcharging you in 2026 and a massive loophole that lets you switch plans without answering a single health question. Here's the thing most people never find out. The insurance companies know you are terrified of medical underwriting. They know you think if you switch plans, they will deny you for your pre-existing conditions. So they just keep raising your premiums year after year, and you just keep paying. The money is sitting there. The rules are written in your favor. But every month that goes by without you making the right move is another month of overpaying the insurance companies. I went through the latest 2026 Medigap premium data, the federal Medicare guidelines, and the state-specific switching laws. And I found 3 specific overcharges that millions of seniors are completely ignoring. I'll walk through each one, tell you exactly how the math works, and what to do about it. Stay until the end because the penalty-free switch loophole is the ultimate hack that lets you bypass medical underwriting entirely, and almost nobody is talking about it. Real quick, before we get into it, if you're not subscribed to this channel yet, hit that button right now and turn on notifications. The rules around Medicare change every single year. Premiums shift, new plans open up, old ones get updated. I cover all of that in plain English, so you always know what you're actually entitled to before it's too late to act on it. The people who are subscribed stay ahead of this stuff. The people who aren't tend to find out too late, right when their premium doubles. So subscribe now, and let's get into it. To understand why your bill is so high, you have to understand what is happening in the Medigap market right now. Over the last 2 years, Medicare supplement premiums have been rising faster than inflation. Insurance companies are quietly hiking their rates, banking on the fact that seniors are too scared to switch to a cheaper plan because they fear losing their coverage. They rely on your fear of medical underwriting to keep you locked into an expensive policy. The insurance companies aren't going to send you a warning letter telling you that you are overpaying. They just send the bill. You have to know the traps to fight back. Let's get right into the first one. Overcharge number 1 is what I call the Plan F legacy trap. This is the silent killer of senior retirement income. Plan F is the most comprehensive Medigap plan ever created. It pays for everything, including the Part B deductible. But here is the catch. Federal law changed a few years ago, and Plan F is now completely closed to anyone who became newly eligible for Medicare on or after January 1st, 2020. If you are on Plan F, you are in a legacy risk pool. Because no new, younger, healthier seniors are allowed to join your plan, the risk pool is literally aging out. The people in Plan F are getting older and using more healthcare. When an insurance company's risk pool gets older and sicker, they have to raise the premiums for everyone in that pool to cover the costs. If your Plan F is rated by attained age, meaning the premium goes up automatically every year as you get older, your bill is going to skyrocket in 2026. You are paying a massive premium for a plan that is slowly dying. The smart move is to look at a community-rated Plan G. Community-rated plans charge the exact same premium to everyone, regardless of age. By moving from an attained age Plan F to a community-rated Plan G, you can often save hundreds of dollars a month, and you still get almost the exact same coverage. Overcharge number 2 is the Standard Plan G Overkill. This is the one that catches people who think they are being smart with their healthcare. Let's say you looked at your options and decided you want Plan G because it covers almost everything. You sign up for Standard Plan G, and you are paying $200, maybe $250 a month. You think you are getting a great deal because you never get a medical bill. But you are actually overpaying for benefits you might never use. Here is the secret the agents won't tell you. There is another version of this exact same plan called the High Deductible Plan G, or HDG for short. The HDG plan has the exact same core federal benefits as Standard Plan G. It covers the exact same hospital stays, the exact same skilled nursing facilities, the exact same foreign travel emergencies. The only difference is that you have to meet a small annual deductible before the insurance kicks in. In 2026, that deductible is $257. Let that sink in. If you are healthy and you don't go to the hospital, you only pay the first $257 of your Medicare-covered costs for the entire year. After you hit that $257, the HDG plan pays exactly 100% of the rest, just like Standard Plan G. But because you are taking on that small deductible, the insurance company slashes your monthly premium. Instead of paying $250 a month, you might only pay $50 a month. That is a savings of $2,400 a year. You keep the difference in your pocket, and you still have absolute protection against a catastrophic hospital bill. If you have some savings in the bank to cover a $257 deductible, Standard Plan G is a massive waste of your money. Overcharge number 3 is the Plan N Copay Illusion. This is the trap that catches people who are trying to save money but end up paying for benefits they never actually use. Let's say you heard that Plan G was too expensive, so you went with Plan N to save a few bucks. Plan N is a great plan, but it has a catch. It requires a $20 copay for office visits and a $50 copay for emergency room visits that don't result in an admission. A lot of seniors sign up for Plan N, pay their monthly premium, and then refuse to go to the doctor because they don't want to pay that $20 copay. Or they sign up for Standard Plan G, paying an extra $50 a month just to avoid the Plan N $20 copay. Here is the math you need to do. If you only go to the doctor twice a year, that is $40 in copays for Plan N. If you are paying an extra $600 a year in premiums for Standard Plan G just to avoid those $40 in copays, you are literally throwing your money away. You have to look at your actual health habits. If you rarely visit the doctor, Plan N is a fantastic, low-cost option. Do not pay for the illusion of zero copays if you are never going to use them. Match your plan to your actual medical needs, not your fears. Now, here is the part that changes everything. This is the ultimate hack that insurance agents will never tell you about because they want to keep you on their expensive books. It is the penalty-free switch. The biggest reason seniors stay on overpriced Medigap plans is the fear of medical underwriting. They think, if I switch to a cheaper plan, the new insurance company will look at my medical history, see my high blood pressure or my diabetes, and deny my application. If that happens, they are stuck with their expensive plan forever. But there are two massive legal loopholes that completely bypass medical underwriting. Loophole number 1 is the Medigap Birthday Rule. If you live in certain states, like California, Oregon, Idaho, Nevada, Illinois, or Missouri, you have a special legal right. Every year, during a specific window around your birthday, usually 30 to 60 days, you can switch to a Medicare Supplement plan of equal or lesser benefits without answering a single health question. No medical underwriting. No health questionnaire. The insurance company cannot deny you, even if you are sick. If your current premium is too high, you just use your birthday rule window to switch to a cheaper company with the exact same Plan G. Loophole number 2 is the 63-day guaranteed issue window. If you recently lost other health coverage, like employer insurance, or if your Medicare Advantage plan is leaving your area, federal law gives you a guaranteed right to buy any Medigap policy sold in your state with zero health questions asked. You have exactly 63 days from the moment you lose your old coverage to make this move. If you miss that window, the medical underwriting trap snaps shut. Write this down. Knowing your state's birthday rule and your guaranteed issue windows is the only way to switch plans safely. So, let's bring it all together. 3 overcharges for Medicare Supplement holders in 2026. The Plan F Legacy Trap, where an aging risk pool causes your premiums to skyrocket. The Standard Plan G Overkill, where you pay massive premiums when the high-deductible Plan G offers the exact same catastrophic protection for a fraction of the cost. The Plan N Copay Illusion, where you overpay for zero copays that you never actually use. And the ultimate solution, the penalty-free switch, using your state's birthday rule or your guaranteed issue window to bypass medical underwriting entirely. None of these strategies happen automatically. The insurance companies are not going to lower your premium unless you understand the rules and force them to compete for your business. That knowledge is genuinely the only thing standing between you and your hard-earned retirement savings. Healthcare costs should not be eating up your fixed income. You work too hard for your money to just hand it over to an insurance corporation. If this video helped you, please subscribe and pass it along to someone you know who is complaining about their Medicare bill. A husband, a wife, a friend, a neighbor. One conversation can save someone thousands of dollars this year.